Have you ever looked into that intense world of day trading and really wondered what sets the legends apart? Beyond the flashy stuff, the dream of instant wealth, there's this whole realm of precision, patience, and incredible self-control.
Absolutely.
So today we're doing a deep dive into the story of one of the most, enigmatic and successful traders out there, Takashi Kotegawa. You might know him as the bedroom trader.
Right. And we've pulled together insights from quite a few places, a big guide on day trading, articles focused just on his journey.
Yeah, lots to unpack.
Our mission here really is to pull out the key lessons, the actionable stuff from Kotegawa's career. Because, yes, his initial jump came from this almost unbelievable event.
Oh, yeah, we'll get to that.
But his continued success, that was forged through like an almost scientific approach, strategy, discipline. That's what we're digging into. His principles, his tools, and maybe the most important part, his mindset.
Okay, so get ready. We're going to try and uncover the secrets of how this trader turned, about 13 grand into an astonishing $153 million.
Incredible numbers.
And figure out how you might apply some of these powerful ideas to get a well-informed edge, really, no matter what you're doing. Okay, let's set the scene. It starts around 2000. Takashi Kotegawa, nobody really knew him then, trading from his bedroom in Japan.
Right, and he started with $13,600. Pretty modest, actually. Lots of people starting out today might begin with something similar.
Yeah, relatable in that sense.
But what's just staggering is that over only 8 years, he grew that initial stake to $153 million.
8 years?
Yeah, that kind of consistent, massive profit. It's incredibly rare. So rare, people apparently wondered if he was even, a real person.
And here's where the story gets really wild. That defining moment, people call it the trade of the century. December 2005, JCOM Holdings.
Ah, yes, the Mizuho mistake.
Exactly. A trader at Mizuho Securities makes this huge error. Instead of selling one share at $610,000.
Which is already a lot of money.
Right. They accidentally put in an order to sell 610,000 shares at just 1 yen each.
1 yen, basically giving them away.
The stock price just collapsed, down 59% in minutes. Total chaos.
So the big question then is, okay, chaos erupts. What does Kotegawa do?
Right. While everyone else is probably panicking or just staring at the screen.
He sees it differently.
Instantly. He recognized it had to be a technical glitch, a fat finger error. And he figured, okay, this is going to bounce back fast once they sort it out.
So he didn't panic buy. He saw the recovery potential.
Exactly. He jumped in, bought 7,100 shares at that rock bottom price, maybe around 570,000 average, and sold them quickly as it rebounded.
And the profit from that one trade?
About $20 million. In a day.
Wow. Okay. A massive accidental jackpot. But we should definitely stress, like our sources do, that kind of specific, huge broker error, it's really unlikely to happen again today with modern systems and checks.
That's a really important point. So what's the takeaway here? Yes, that windfall was spectacular, totally unique, but it wasn't the only thing.
Right. It gave him a huge capital base, sure. But his real legend, the reason we're talking about him years later, was built on the consistent, methodical approach he used after that. The millions he made over the following years.
That's where the real lessons are.
Yeah.
His sustained success, it wasn't luck. It came from this really deep trading philosophy. He had that famous quote, "The market is a sniper rifle, not a machine gun."
I love that quote.
What does that tell us? How is that so different from how maybe beginners think about day trading?
Well, that sniper approach, it just perfectly captures his extreme patience and selectivity. He wasn't firing wildly.
Yeah, not just clicking buttons.
Exactly. He treated trading like a serious business, a calculated hunt for very specific opportunities, not some get-rich-quick casino game, which is, let's be honest, how a lot of newcomers approach it, trying to catch every little wiggle.
Right. So his principles, the sources, lay them out pretty clearly.
Yeah, and they're timeless, really. Useful for anyone dealing with volatility. First, discipline above all. Every single trade was part of a clear plan. Based on his analysis, never on emotion, never chasing losses. He famously wouldn't try to win back money after a losing trade by betting bigger. That's a classic trap he avoided.
Crucial. And risk management.
Absolutely paramount. He never risked more than, say, 1 to 2% of his total capital on any single trade.
Wow, only 1–2%?
Yep. That meant he could ride out losing streaks without blowing up his account. And he always looked for a minimum profit-to-loss ratio of 2.1. So the potential reward had to be at least double the risk.
Makes sense. What about his analysis focus?
Deep technical analysis. What's really interesting here is he apparently paid very little attention to fundamental analysis, company earnings reports, economic news.
Really? He ignored all that?
Largely, yeah. He believed everything he needed to know was already baked into the price charts, the patterns, the volume. That was his world.
Okay. And his mindset during trading?
Emotional neutrality. This is maybe the hardest part. He famously talked about approaching trading like a video game.
A video game with millions on the line.
Sounds crazy, right? But it speaks to his detachment. He tried to separate himself from the emotional roller coaster of winning and losing money. He even valued a good losing trade, one that followed his rules perfectly, more than a bad winning trade where he got lucky but broke his own process.
That takes serious discipline. And the last key principle.
The power of the trade journal. This wasn't just jotting down P&L. He documented everything.
Like what?
The asset, entry, exit, the indicators he used, his reasoning for the trade, the outcome, and critically, even how he was feeling emotionally during it.
Wow, tracking emotions too.
Yeah, because that constant analysis helped him refine his strategy, spot his own biases, his own behavioral patterns that might be hurting him. It was constant self-improvement.
Okay, so this disciplined philosophy.
Yeah.
How did it actually look on his screen? The sources say his technical toolkit was surprisingly minimal, right? Not overly complicated.
Yeah, exactly. No secret, complex algorithms. He mastered readily available tools, so when he looked at a chart, his first step was usually identifying the main trend.
How did he do that?
Primarily with moving averages. He liked the 25-day moving average and especially the 50-period exponential moving average, the EMA.
EMA gives more weight to recent prices, right?
Exactly. So price above the 50 EMA, bullish trend. Below it, bearish, simple baseline. He'd also glance at the 200 EMA just to confirm the longer-term picture, make sure he wasn't fighting a massive tide.
Okay, trend established, then what?
Then he'd zoom in on the Japanese candlesticks. These were fundamental for him. Open, high, low, close, each candle told a story.
Like the color telling you buying or selling pressure.
Right. Hollow or white candles meant buyers were in control, close higher than the open. Filled or red meant sellers were winning, close lower than the open. But he looked beyond single candles at specific patterns.
What kind of pattern?
Things like spinning tops, those small bodies with long shadows signaling indecision, maybe a potential reversal brewing.
Okay.
Or doji patterns where the open and close are basically the same. Huge indecision. Could signal a bottom reversal like a hammer doji or a top reversal like a shooting star. These were critical signals for him.
But he wouldn't just trade based on a candlestick pattern alone, would he?
Never. That's where volume came in. This was absolutely critical. He'd only consider entering a trade if there was a significant volume spike, the sources say at least 50% above average.
Why was volume so important?
It confirmed the move, a price breakout on low volume. He'd likely ignore it, thinking it wasn't genuine conviction. High volume meant the move had strength behind it.
Got it. So trend, candlestick pattern, volume confirmation. Anything else?
Yeah, he used the RSI Relative Strength Index as another filter.
To spot overbought or oversold conditions.
Yes, that's the standard use. Above 70 is overbought, below 30 is oversold. But for Kotegawa, it was also about avoiding trades when the market was already stretched thin. He actually preferred to enter when the RSI was more in the neutral zone between 30 and 70, suggesting there was still room for the price to move in the direction of his trade.
Interesting. So it wasn't just about fading extremes.
Right. And he also used Bollinger Bands.
For volatility.
Exactly. When the bands expanded, widened out, it signaled that volatility was picking up and a strong price move was likely coming. That helped him anticipate bigger moves. And sometimes, for finer detail on really short time frames, he'd look at the MACD moving average convergence-divergence for those crossover signals.
Okay, so a mix of trend, pattern, volume, momentum, and volatility indicators.
Plus, fundamentally, support and resistance levels. He was constantly identifying these key price zones where the market had reacted before, paused, or reversed.
Areas tested multiple times.
Often, yeah. 2 or 3 tests would make a level significant in his eyes. These levels were crucial for pinpointing breakout points or potential reversal zones. He'd wait for a clear break through these levels, again, ideally with that volume confirmation.
And he tied it all together with
multi-time frame analysis. Super important. He'd look at the same asset on, say, the 1-hour chart for the big picture trend, the 15-minute for confirmation, and then the 5-minute or even 1 minute for the precise entry trigger.
So checking signals across different perspectives to filter out noise.
Exactly, making sure the story lined up across the board before committing capital.
The sources also mention he looked for stocks in play. What does that mean?
Yeah, so instead of just trading anything, he'd look for stocks that were moving because of some specific news or catalyst related to that stock, not just because the whole market was going up or down. High relative volume was key here, too.
And he even categorized them.
Apparently so. By float, the number of shares actually available for trading, and by price range. He might have slightly different tactics for low float penny stocks versus large cap names. And speed. He used hotkeys.
Keyboard shortcuts.
Yeah, pre-programmed keys to buy or sell instantly.
Yeah.
In fast-moving markets, especially on short time frames, that speed of execution is critical. Milliseconds can matter.
Okay, so we have the philosophy of the toolkit.
Yeah.
How did this actually play out in a trade? Let's try that hypothetical scenario the sources describe. He liked bear markets, right? Looking for pullbacks.
Yeah, he often looked for stocks that had pulled back significantly, say 20% below their 25-day moving average, and then he'd play the bounce. But let's use that EURUSD example they gave. Maybe it makes it clearer.
Okay, USD. Imagine we're using a demo account, say $50,000, following his rules. London session, things are moving. What's step one?
Step one, trend analysis. You pull up the 5-minute chart. Okay, price is grinding above the 50 EMA. Looks bullish short term.
But need confirmation.
Always.
Yeah.
Check the 1-hour chart. Price has just broken through a key resistance level, let's say 1.146 INRO. And crucially, look at the volume bar. It's high on that breakout candle.
Okay, so longer term confirms the bullish bias. Now for the entry signal.
Back to the 5-minute chart, you wait patiently. Sniper rifle, remember?
Great, no machine gun.
And boom. A bullish engulfing pattern forms right near that 1.14600 level, which should now act as support. That's a strong buy signal. Quick check on the RSI 14, it's reading 55.
Neutral zone. Not overbought. Good.
Perfect. It suggests the move has legs.
Okay, signal confirmed.
No.
Risk management, Kotegawa's cornerstone.
Absolutely. We're risking 1% of our $50 demo account. That's $500 risk. So we place our stop loss order just below that support level and the recent candle low, maybe at 1.14500.
And the profit target needs to be at least 2.1 reward to risk.
Right. So if our risk is 10 pips from 1.14600 entry to 1.14500 stop, our target needs to be at least 20 pips away. Let's aim for 1.1480, giving us a 1.2 risk reward.
Okay, stop loss at 1.1450, entry around 1.1460, take profit at 1.14800. Make sense? What about the multi-time frame check?
Good point. Quick glance at the 15-minute chart. Yep, price is clearly in an upward channel. And look, the Bollinger Bands are starting to widen out.
Signaling increasing volatility, supporting the potential for that upward move.
Exactly. All the pieces are lining up across the time frames. We take the trade.
And in this hypothetical,
Let's say after maybe 15-20 minutes, the price pushes up cleanly through 1.1480. Our take profit order gets hit. Trade closed automatically.
for a profit based on that 1.2 ratio.
A successful trade executed according to the plan. And the sources show similar setups for other pairs, GBP USD, USD JPY, even assets like crypto or stocks reacting to news. His core method was adaptable. He often favored that really quick trading, 1 to 15-minute holds, perfect for those sharp, fast moves.
It sounds so methodical. But we know trading isn't just charts. That psychological edge, that seems to be where Kotegawa truly excelled.
Oh, absolutely. That was his secret weapon, if you like.
What are those big emotional traps that catch most traders out? The ones he seemed immune to.
Well, it's why the failure rate is so high, sadly. You know, statistics suggest something like 90% of beginners lose their initial deposit pretty quickly.
90%, wow.
Yeah, and it's mostly down to emotional errors. Think about greed. Taking positions that are way too big, hoping for that one lottery ticket win, setting completely unrealistic profit goals.
Or the opposite, fear.
Exactly. Fear makes you jump out of good trades too early, just because of normal market fluctuations, or paralyzes you so you miss good opportunities altogether.
And there's just jumping the gun.
Impulsiveness. Trading out of boredom or because you feel like you should be doing something. Taking trades that don't meet your carefully defined criteria.
And the worst one.
Revenge trading. After a loss, you feel angry, frustrated, and you immediately jump back in, often bigger, trying to force the market to give you your money back.
Which usually leads to
Even bigger losses. It's a downward spiral.
So Kotegawa somehow built defenses against all of that.
Yeah.
How did he manage to stay so disciplined? It seems almost robotic.
Well, he was human, but he worked incredibly hard on it. For him, discipline was everything. He stuck to his plan religiously. A loss was just feedback, data, not a reason to abandon the plan or chase the market.
The sniper, not the machine gun.
Precisely. Patience was built into that. He would genuinely wait, sometimes hours, maybe even days, for a setup that met all his criteria. He resisted the urge to trade just for the sake of trading.
And managing expectations.
Crucial. Focusing on those consistent, smaller wins, maybe 1–2% profit per trade, rather than swinging for the fences, that helps you stay calm even when you take a loss, because you know it's just part of the probability game.
And that emotional neutrality, the video game idea.
Yeah, cultivating that objective distance. Viewing trading as a process to execute flawlessly, not a personal battle against the market. Making decisions based on the plan and the data, not on how he felt about the money. It's incredibly difficult, but that was his goal.
Okay, but how did he maintain that? What were the practical techniques? It's one thing to say, be neutral, quite another to do it.
The sources point to a few key habits. That trade journal was huge. Including his emotions in it allowed him to see patterns. Okay, when I feel anxious, I tend to exit too early. That kind of self-awareness.
So the journal wasn't just numbers, it was psychology too.
Absolutely. Also, meticulously planning each session before he started trading. Defining his maximum allowable loss for the day, the specific signals he was looking for. That prevents impulsive decisions in the heat of the moment.
Having a plan before the battle starts.
Exactly. And taking deliberate breaks, especially after a loss. Stepping away, clearing his head, preventing that urge for revenge trading.
Resetting emotionally.
Yeah. And fundamentally prioritizing sticking to the plan above everything else. Judging his performance based on how well he executed his strategy, not just on whether a trade won or lost. That mental shift is powerful, especially for navigating really volatile pairs like USDJPY, where news can cause sudden spikes.
Okay, so tying this all together for someone listening, maybe they're curious about trading, maybe just interested in decision-making under pressure. Kotegawa's approach seems really relevant today, doesn't it?
Totally. Across different markets, Forex, crypto, stocks, the principles translate.
And our sources actually boil it down into a pretty practical 10-step checklist based on his methods.
Yeah, it's a great summary.
Okay, step 1, open a demo account. Practice without risking real money first. Makes sense.
Crucial first step. Get familiar with the platform and the process.
2, set up your indicators. The core ones he used: 50 EMA, RSI, Bollinger Bands, volume.
Get your charts looking like his battlefield.
3, choose your trading time. Focus on high volatility sessions like London or New York, but maybe avoid huge news events.
Pick your hunting ground and time.
4, learn candlestick patterns. Master those key signals like the hammer, engulfing, doji. Learn to read the price action.
Understand the language of the market.
5, perform multi-time frame analysis. Use the 1 hour, 15-minute, 5-minute combo to confirm signals.
Get that layered confirmation.
6, set risk management rules. That strict 1–2% risk per trade, minimum 1.2 reward risk ratio. Always use a stop loss. Non-negotiable.
Protect your capital at all costs.
7, create a trading plan. Before you trade, outline everything: timeframes, indicators, risk, signals you're looking for.
Plan the trade. Trade the plan.
8, wait for a sniper signal. Be patient. Only enter when everything aligns: pattern, RSI, volume, Bollinger Bands expanding.
Quality over quantity. Wait for the A+ setup.
9, keep a trading journal. Document everything: asset, time frame, indicators, entry, exit, outcome, and your emotions.
Your personal feedback loop for improvement.
And finally, 10, review and improve. Regularly analyze that journal. Find your mistakes, see what works, refine your discipline.
Constant learning, constant refinement. That's the path.
It sounds demanding, but actionable.
Yeah, and the sources even mention examples of traders applying these principles. Anna, a beginner, focusing just on discipline and risk. Marcus, more intermediate, adding filters like MaxiD. Lisa, a pro, using advanced tools like Fibonacci, but still grounded in Kotegawa's core ideas.
So it scales from beginner to pro. It's about that disciplined foundation.
Exactly. It shows these principles work if you commit to them. It's about high-precision execution, whether in trading or really any complex analysis.
But we've taken this deep dive into Takashi Kotegawa, a genuine legend. Turned that small stake into a fortune, not through some mystical gift, but through just relentless discipline, sharp thinking, and this incredible calm. That JCOM trade, yeah, that was a once-in-a-lifetime event, a huge anomaly.
A massive slice of luck, no doubt.
But his consistent success for years after that, that's the real story. That's the blueprint for navigating complex situations.
Absolutely. His journey really underscores that lasting success in almost any field isn't about chasing every shiny object or just getting lucky breaks.
That's the deeper stuff.
Yeah. It's about cultivating patience, real patience, mastering your own internal state, your emotions, Rigorously analyzing the information you have and then sticking to a well-thought-out plan. Those principles, risk management, solid analysis, psychological resilience, they're just universal.
So as you're thinking about all this, here's maybe a final thought to chew on. How could applying just one of Kotegawa's core ideas change things for you? Maybe it's waiting for that sniper signal in your own decisions, resisting the urge to jump too soon. Or maybe it's starting a journal, not just for trading, but for understanding your own thinking patterns when you make important choices. How might that kind of discipline transform how you process information and make better decisions, whether it's in the markets or just navigating life?